Welcome back to Finweek Money Matters. Now, South African households remained under severe financial pressure due to a weaker rand, rising food and fuel costs. The recent interest rate hike will result in many home buyers having difficulty raising bond finance, which will further boost the demand for rental property. Finweek looks at property letting management trends that will prepare both landlords and tenants for 2014. Joining me now at the desk is Michelle Dickens. She's the founder and MD of TPN, and Glenn Norton, broker and owner at Remax Masters. Thank you so much for making the time to join us. Michelle, maybe let's start with you. I mean, I picked up an article here that says there was a TPN survey released last year that said there was a growing supply shortage in the residential rental market, and now on the back of these this interest rate hike in particular, have you begun to see the turnaround, or is it just way too soon for now to starting maybe in a few months from now?
Sure. So we're still seeing a rental supply shortage. There's still an over demand of tenants looking for properties. The problem, of course, is that not all of the tenants are well qualified. So although we have a high volume of tenants looking for properties, stock is short and qualified tenants are scarce at the moment.
Glenn, maybe some context for us for this discussion. What's in demand at the moment in terms of stock from a property, a landlord looking to buy property to subsequently rent on?
All right. From a landlord's perspective, there's a huge demand. Okay. From a tenant's perspective, our most popular price range right now is most probably between 6 and about 12,000 rand, your lower middle segment. From a landlord's point of view, your best investments to buy generally are 2-bedroom, 2-bathroom units. We find that they rent out very quickly. You might have a young couple, you might have 2 ladies sharing or 2 gentlemen sharing, so they split the rent, it makes it more affordable. We also find that your return from an investor's point of view is very, very good in that particular segment.
Do you think that's about to change now that consumers are under more pressure? Do you think the 2-bed, 2-bathroom would maybe not be as popular anymore in a few months?
From my personal perspective, you've got to remember that it depends completely in your price sector and also the different areas that you are dealing in. But the bottom line, okay, is that the majority of people that actually rent, okay, are young people, youngsters, starting out, just starting their first job, and so on. And with the new bank regulations requiring deposits and that, they're actually forced to rent. So because they need to save up either a 10 or 15 or 20% deposit. So that's the first part of it. The second part of it is that a lot of people during the economic financial crisis, okay, got impaired credit ratings, so therefore they actually do not qualify for bonds. So therefore they're forced into the rental market, and this is what is actually fueling that particular demand.
Michelle, I want to take that because I want to throw it back at you. Is that the reality? I think there's a perception out there that banks are not giving bonds anymore. But I flipped to the other side and I talked to a lot of bankers, and they're desperate for, they really are trying to find people to lend to. Is there a perception that if I've got a bad credit record at the moment, I'm not getting a bond?
I think it's more than a perception. When you look at actual decline versus accept ratios, the ratio of declines or rejection is on the increase. So we're sitting at 57% of credit applications being declined, and that's slowly increasing quarter on quarter. Coming back to what Glenn was saying, when you look at the number of tenants remaining in properties, whereas we were seeing tenants exiting rentals at around about 27, 28 years of age, we're now seeing them exiting at 30, 31 years. So you can see tenants are in the market for longer, for a number of reasons, one of which would be the banks.
Let me jump in there because we've got a caller on the line. Hello, Zilla. Can you hear us, and what is your question?
Hi, I'm at the moment. And I'd like to find out at what age shall I start thinking about a business plan that I can put together for perhaps a clothing and merchandise business. And is there any particular subjects that I could study in terms of entrepreneurship?
Okay, thank you so much, Zilla, for your call. Very much divergent from what we're talking about, but I always have my right-hand lieutenant who can take any question thrown at him. Mark, so she wants to know. She wants to start her clothing business. Your thoughts on that and how she should approach the process?
Look, it's a big jump sideways from it. But I mean, I'll bring it back to this discussion we're having at the moment, because I do think that consumers are under pressure. Don't go and jump into starting a business right now. I'm mind blown by the idea that somebody at 31 is still renting a property as opposed to having assets to their name. If you want to go and start a business, nobody's going to stop you, but be aware that consumers are under pressure, and in a consumer-facing sector like the like fashion is likely to be incredibly expensive. It's a very risky venture at the moment.
Okay, of course, unless the person decides that instead of the fashion business, they're going to actually buy to rent as a particular investor. So maybe come back to you, Michelle, on that. Relatively speaking, how's the rental market performing to normal, say, house price growth at this time?
So house price growth is on the increase. The yields at the moment are sitting at around about just short of 10%, so 9.8% at the moment, and that's overall, and that's on our gross yields. And what I always caution our investors and our landlords that's the gross yield. Our investors still need to take into account their levies, their special levies. Big problem with special levies in sectional title at the moment. Their maintenance costs on their properties. All of these additional expenses need to be deducted before we get to the net yield. Coming back to what Glenn said about which property an investor should be looking at, if we bring in the numbers into that, certainly our 1 and 2 bedroom sectional title properties are performing best.
Glenn, what about... Yeah, I was going to say, we were chatting student accommodation last week, and it seems to be a huge supply issue around student accommodation. And being the typical capitalist that I am, I thought, gee, this sounds quite good. What about buying around universities for that 1 or 2 bedroom type sharing agreement?
Very, very good investment, good return. We find that it works generally in a 4-year cycle. Okay, I'll give you an example. If you've got 100 townhouses, in a complex, on average your degree is around about 4 years. So very often moms and dads, they decide they don't really want to pay all the student accommodation in rent, so what they do is they invest for a period of time, and then when their children move on after the 4th year, they actually sell it, and not only have they saved themselves money, they actually get a return on their capital investment, so that it's not like they're just taking the rent and paying somebody else. A good example would be the Yard, which is in Auckland Park. It's close to all the universities. We've currently got a waiting list there, right here, right now, for approximately 25 students that would like to go into that particular complex.
Let's look at the geographic makeup. I saw a very interesting article or report, I think it was about 2 or 3 weeks back, that said if you look at high net worth individuals, people in Johannesburg have the money, but people in Cape Town have the class. I think that was the distinction. And we had a big fight about that with the guys in the Cape Town studio. But geographically speaking, if you want to get into the buy to rent space, where should you be looking? Is it the typical Gauteng and Western Cape hotspots?
All right. I'm quite an astute in property investor myself. I own quite a few units in that, and I generally like to invest quite close to where I actually stay because I want to keep an eye on what I'm actually buying. You can buy all over, but you've got to understand that if you need to manage the property and you need to get there, this can be a huge problem, along the way. So look, I have my hot spots that I like to buy. I always maintain inside of the ring road here in Johannesburg, in other words, inside of the N1 is always better than on the outside. You find that the closer you are to certain business locations like the CBD here, Sandton, makes for very good investments as well, but your entry level is also quite high in terms of what you've got to spend to get in for an apartment. I don't really have any areas that I think are really, really good. But what I do want to warn people about is drive around and look at the neighborhoods that you're going to invest in when it comes to buying a sectional title unit or a house for that matter. Because if the neighborhood is going into a state of decline, there's a good possibility you're not going to get a good return, and you're not going to get a good return on your rental investment.
Michelle, what about interest rates? Because I think that this is topical. How are you guys factoring that in? What do you expect that to impact that's going to have?
Definitely. When we look at our data, we see a 9-month lag between interest rate increasing and tenant declining. And right now, we're seeing tenants sitting at the top of of their behaviour levels, from a low of 71% in 2008 up to 86% with tenants in good standing at the moment, and that's the best it's ever been. So we're at the top of the peak. Interest rates go up, and we're going to see a 9-month lag, and we're going to start seeing deterioration in tenant behaviour.
Do you find that people sublet their houses where they live?
Not so much in residential. In commercial, that's a big part of the commercial property behaviour, but in residential, no, not at all. We tend to see that, especially with the Consumer Protection Act, tenants are afforded a 20 business day cancellation period. So they take their 20 business day, they pay their penalty, they move on.
Unfortunately, that's all that we have time for this week's edition of Finweek Money.